If you own real estate, you should always do a cost segregation study because you can use it in this instance that you just discussed, and you may have a really high cash flowing property like your short term rentals in Colorado. Those will exceed the normal cash flow on a piece of property, and so if you have a high cash flowing property, I mean, it certainly makes sense to do that.
Hey, Renter Retires, it's Adam Schroeder here with another episode, joined as usual by the founder and CEO of Renter Retirement, Zach Lemaster. And today we are going to talk about taxes. We're going to talk about cost segregation. We're going to talk about all the things that you don't think about whenever you first start investing in real estate. And that is with Mr. Steve Trussell. Steve, thanks for joining us today.
Thank you for having me.
Absolutely. So I know we've done other episodes with you talking about cost segs before. People have heard Zach talk about cost segs because he loves them. He lives and breathes by them. But tell us a little bit, just in general, remind people what a cost segregation study actually is.
Okay. It's segregating the asset. And what that means is typically a residential is 27.5 year depreciation cycle and commercial is 39 years. So obviously all of those parts and pieces of the real estate don't or last less than 39 or 27.5 years. So you have the building as one of the components, which is your longer life. But a lot of the components inside the property, like carpeting, lighting, things that expire in shorter periods of time or don't last as long, we can bring 20 to 30% of that forward into a cost segregation study. Our engineers break down the building, rebuild it basically, and segregate the 5 and 15-year property. 15-year property is what's outside your parking lots, your driveways, your landscape, things like that, your sprinkler systems. 5 years, what's inside, the carpet, the things like that inside the building. So we segregate that. 20 to 30% of that comes forward. And with bonus depreciation, which came about, it was July of 2017, up through December 31, 22, you can bring 100% of that forward and use it in the current year, the current tax year. You can do that all the way up until you file your taxes for that year. So if you're in 22, if you've extended your 22, you're still eligible until you file your taxes, as long as the report is done prior to filing taxes. And starting in 23, that bonus goes to 80%. Next year it goes to 60, then 40, 20, and then it goes away. That doesn't mean cost segregation is not a benefit. You still would want to separate your asset into 5 and 15-year categories and have a shorter life for part of the building, part of the property.
All right, so we're getting immediately granular, and I'm going to back up a little bit just for people that are like, well, I've never heard of cost seg, or like, what the hell did Steve just say? So let's back up a little bit, and don't let me forget, one thing I want to talk about today is people that have properties that they've owned previously that they want to explore accelerated depreciation on. That I think it is super essential to don't let me forget that one, but
will not be forgotten.
Okay, so let's just start at depreciation. And I'm going to paraphrase for you, Steve, and try to simplify things for the audience. Tell me if I'm incorrect here at all. But depreciation, what is that? Basically, depreciation means property is a physical asset. We're actually talking about the improvement on when you have real estate, you have land, and you have a house. We're talking about the actual improvement, house on the land. And so basically the improvement is a depreciating asset, just like a vehicle, like it wears out over time. Even though it goes up in value, the government allows us to basically take tax deductions off of that, and we'll reduce our tax basis or reduce our income on that by taking an expense on the property. Actually, you're required to, per our IRS guidelines, this is not an optional thing, you're required to take depreciation. But basically what you're saying is, if I have a $100,000 house, that's a residential rental. It depreciates over 27.5 years. Who knows who came up with that number, but there it is. So $100,000 house divided by, and we're not sectioning out land in this to be complicated. Usually land is a minimal portion, but $100,000 house divided by 27.5 years, it's like 3.3 thousand per year, whatever it is that you can reduce. Say you had $5,000 of income on that property, you reduce your tax basis by 3.3 thousand. So you're basically reducing your income. And then on commercial property, because it's built differently, it has different components to it. It has things that last longer. So the depreciation is 39 years. Did I do a good summary with that? Anything you want to add to depreciation?
No, that's correct. You take the land out. Land is usually 15%, depending on where it is. If it's in, La Jolla, California, it's probably 25%. But typically across the United States, 15% land is typically what we would use. Yeah, you take the balance of it, which is attributed to the building or the structure, and then you depreciate over the life, residential or commercial.
Yep. Sometimes in the Midwest, you can have land that's even significantly cheaper, less than 5% sometimes. So you get more depreciation in that case, which a lot of people don't think about. But that's another benefit of Midwest. So okay, so that's depreciation and something you're required to take on an annual basis, and that's what allows us. One of these big things that allows us to have tax-free income, because we have a positively cash flowing property that's appreciating over time, but is being, in the eyes of the IRS, is being looked at as a depreciating asset. And you can recycle depreciation. We'll talk about that as well on properties. You can use it multiple times. But let's so the cost seg study, what that basically is it says you are having an actual study done of evaluating. I know when you're doing them for my properties, this is an actual engineer that's giving a detailed report of all the things in the house or the building that are not going to last 27 and a half years, or in commercial 39 years. I mean, pretty much everything inside the walls, right, is not going to last. Right. And so basically what you're doing is you're taking a portion of that, call it 30%, and you're taking accelerated depreciation. And so the cost segregation study is a report that is a breakdown of all those items that you are accelerating and depreciating. It's not obviously going to last 39 years. You could not do this and have those go over 39 years, or you can be a creative investor to accelerate those. And what is called bonus depreciation is taking all of that. Say you get a list of 30% of the items that are not going to last 39 years and taking that all in year one. So you take a 30% deduction in you take 30% of your depreciation in year one. The rest of the 70% of depreciation you would take over the normal 39 years. However, the reason you would do that, like why would someone do this, is because it allows them to decrease their tax basis this year and take depreciation this year. And so what you can do if you're a real estate pro is like offset your income from all these different sources. Doesn't matter what the source is, but you're using that depreciation to offset your taxable liability to reduce your taxable income this year. Like for instance, we're doing this personally because we're buying enough. What we're doing, our strategy is to buy enough real estate to offset our active income from all sources. So we create a loss every single year that carries forward. So if you don't use this in year one, it carries forward year after year. But the reason we do that is so we don't pay, the money in taxes that we would otherwise, to then go out and reinvest and earn income on that. So that's kind of the idea behind doing an accelerated depreciation. Is that correct, Steve, or anything else you want to add to that?
That's correct. Well, one thing to add to it, if you can't use it all day, you can carry forward until you can use it. So typically with your cash flow, if you're in a really good cash flowing market, sometimes your 39 or your 27.5 years not enough to offset your income, so you have a gain. So with cost segregation, you most always will offset your income from the asset, from that property. And then if you're a real estate pro, like you mentioned, you can use your W-2 or your other income if you qualify for that to offset that income as well.
And just one other note about depreciation to understand, depreciation is recapturable. Okay, so when you sell the property, you pay back. Again, you are required by the IRS to take it. In fact, if you don't take it, they factor your taxes in as if you did take it and penalize you. Right. So, I mean, you should be taking it and you have to take it. But you pay it back
one way or another.
Right. And so that's an important thing of having the right CPA on your team, right? But so when you sell the asset, you have to pay it back. The alternative would be you can carry it forward and 1031 exchange it. Like kind of the big picture goal here of people that are building exceptional wealth into real estate is they're doing exactly this. They're buying all these assets, they're doing accelerated depreciation, and then they are holding those assets for a long period of time. And when they do sell them, they are 1031 exchanging and paying it forward, like moving it forward, because eventually you can basically in perpetuity forever pass forward depreciation, right?
You can.
Is that kind of the idea?
It is, but now in 1031, you are going to reduce your basis in the new asset by some of the recapture that you pick up in the old asset, but it's still a worthwhile way to transfer the asset to a new asset through 1031 exchange for sure.
So we won't get super detailed on that, but I think that's just one thing to kind of clarify on the depreciation. So Adam, I keep jumping off here, and obviously this is my topic here. So
I don't want people to just pass this episode over because they heard the word real estate professional and they aren't real estate professionals. Because if we're being honest, most investors are not real estate professionals. When people think of cost segregation, they think about real estate professionals. But as we were discussing before we got started, you do not have to be a real estate professional to take cost segregation studies in your properties, correct? And if so,
Correct.
if not, when does it make sense for people to do it?
Well, to me, it always does. It always makes sense because you have cash flow from your asset, and if it's exceeding your depreciation, you're going to be paying tax on that. And one of the benefits of real estate investing is the tax benefit through depreciation. You don't pay, if you do a property, you don't pay income tax on your gains. So it's always good to have it. I mean, you can also take it against your capital gains of your passive losses as well if you sell outside of a 1031. So if you have multiple properties. So it always makes sense. I mean, you'll always get your depreciation over the 27.5 or 39-year life. But if you got a 5 and 15-year asset as part of the asset, you should be taking advantage of that. Well, what we do in all situations, we do an estimate of benefit to tell you what your property would look like. And it's usually a conservative estimate because I don't want to give you a large number and then come back with a smaller, really do just the opposite of that. So, but that allows you to take a look at that, take a look at the cost of the study, get with your CPA and see if it makes sense for you to do that. 9 times out of 10, it does. Sometimes it may not. It depends on your personal situation. But the estimate gives you a guideline along with the price of the study to decide if it makes sense for you.
do you charge people to do estimates?
No, not at all.
Okay.
I'll turn those around in a few days. And it's just that it's an estimate.
I have to ask you because you've always given me estimates, but I've also always paid for them. So I don't know if you do.
You pay for the study. Now, the estimate, you don't. Once you look at it, once someone looks at the estimate, they look at the cost. And if they like what they see and there's a benefit to them, then we engage in the study. And then that's when they pay.
Steve, what is
he knows you're going to just go ahead and do it. So you don't even bother with the estimate part. It's just, yeah, we're going to do it.
Yeah, that is true. And I'll share a little bit about what I'm doing. I don't want to be too personal, give away all financial information. My wife wouldn't like that, but I mean, I do want to be somewhat of an open book on what we're personally doing, which has been, I mean, quite a lot. Would you agree, Steve? Like we've been pretty aggressive.
You have, yes.
So I mean, we're creating millions of dollars of losses every single year.
Just last year you did, yeah, for sure. But last year was on those 4 properties was a gigantic loss for you. So
we're carrying that forward. So probably our income for the next 2 or 3 years is probably already offset by properties we bought in the past. And we will continue to buy this year too. Because another thing to be conscious of is like, this is a time sensitive thing. You can still do cost segregations and do things with depreciation. But what we talked about with the bonus depreciation, like last year in 2022 was the last year we could do 100%. So just number wise, if you have $100,000 property, you get 30%. I think on most of your estimates, Steve, you come in between 22 to 28% on your estimate. But right. On all of our studies, I think our average study were between 35 to, we've had some over 40%.
Last year we did for sure. Yes.
Yeah. So what we're doing, so basically, if you take that study, you can take 100% of that 40% off of, as an accelerated depreciation in year 1. But now this year, 2023 is 80%. Next year goes to 60%. So this is a time sensitive thing. Like if you're going to do this, you should think about doing it rather soon or this year, because now this year you can take 80% of whatever your study comes back at 40%. So you can take 80% of the 40% of the $100,000 property without getting too complicated, but it's still attractive to do. It still makes sense to do. And it's not like you're losing any depreciation, right? If you're taking a percentage of it, whatever you don't take, you're accelerated, you're still getting normal depreciation like you would anyways. Correct. But here's a couple things, we've talked about this in detail on other videos that we can link to, but just understand, one is that sometimes short-term rentals, there's what we call the short-term rental loophole where you don't necessarily have to be you don't have to be a real estate pro, but if you're actively managing that property and involved in it, you should be able to take accelerated depreciation on those assets and also do cost segregation study. And the second thing to understand too, which the first time I heard about this is like, what? This is like, how do we not know more about this? Because this applies to a lot of people. Don't quote me on the numbers here, Adam. Maybe you remember more than I do. But if you earn, I think it's $150,000 or under, and I believe that could be jointly. You do not have to be a real estate professional, and you can take accelerated depreciation. You can take against your active, I think it's up to $25,000 of active losses. If either of you guys know more details on that, like please state that. But basically that means if you have one rental property and you make $150,000 or less, you can take a depreciation year one of, I think, up to $25,000 without having to be this large real estate professional. That alone is a huge benefit if you fall within that category. Do you guys can you clarify this?
We talked about that, I believe, with Amanda Hahn, if they want to go back and
a few times. Yeah. So we'll link to that, but I don't know, Steve, do you have any other, I don't want to spend a lot of time on that, but it's just something to be aware of. If you're $150,000 or under, like you should be taking probably, in my opinion, I'm not a CPA or attorney, but you should be taking additional depreciation if you're paying taxes. Right.
Yeah. In my opinion, as I said, if you own real estate, you should always do a cost segregation study because you can use it in this instance that you just discussed. And you may have a really high cash flowing property like your short-term rentals in Colorado. Those well exceed the normal cash flow on a piece of property. And so if you have a high cash flowing property, I mean, it certainly makes sense to do that to 0 year, or maybe not zero, but at least wipe out a lot of the income.
So to simplify Adam's question, when does it make sense to do it? Pretty much if you have any taxable income, right? If you have cash flow on the property that exceeds your expenses in your write-offs, if you have capital gains, like if you have taxable liability on the property, you can offset that. I mean, regardless of real estate pro, I mean, now we're just talking about the property, so it doesn't matter. You can still accelerate depreciation on that if you have taxable income on it.
Okay. Yes, correct.
Now, Steve, when it comes to these, let's say, that $100,000 house, let's say I want $15,000 this year, but I don't want to accelerate everything. Is this something you can take piecemeal, or does it have to be, all in one go, 30% was depreciable, so we have to accelerate this now? Or can it be like, I just need 15 grand in write off and I'll take the rest over the next 26 and a half?
Well, the study is the study, and it's going to break down the asset and create the accelerated depreciation regardless. So you can't do a partial study, you do the whole study, but then you take the 15 this year and you carry forward the balance of it to the future years.
Yeah, it would make sense, I think, in my mind, to just do it. Like, why would you not? Because then it's going to carry forward year after year. Like, you're still taking it. It's just a matter of
I'm mostly just thinking, like, if I'm buying something and I think I'm going to hold this 2 to 3 years and I don't want to have to recapture all of it in the 1031 exchange, but if I could just get, 15% of this for the next 2 years to offset my taxes, that'd be great. I didn't know if that was a possibility or not.
It's not, because the study is a study. But I will say, if you're going to sell in, let's say, over the year to 2 years, probably wouldn't recommend. I don't want to turn away any business, but I probably wouldn't recommend you.
That was going to be my question. When does this not make sense? We talked about when it does.
3 years or more. 3 years is kind of borderline as well. So that's part of what the estimate's about. You take a look at that, and then what are your plans for your property? If you're going to hold it for a while, which I hold mine. Then I think it makes sense to do it. But if you're going to turn it in a year or two into something else, I would wait until you finally get something that you're going to hold for a while.
So if you don't have income, and you may not know this until after the fact, right? Or until you're starting to prep your tax structure. So if you don't have taxable liability on the property, if you already have a significant loss, or if you're going to flip it and not hold it for a period of time, which most of our investors are buy and hold investors. We know that that's how you build wealth in real estate over time, is you hold real estate and you do exactly what we're talking about today. Right. That's kind of like the long-term key to, like, without overcomplicating it, maximizing the tax efficiencies and holding real estate over time that's the recipe for success. But those would be the two scenarios. Okay. So if you don't have taxable income on it, or you're flipping it, maybe this doesn't make sense. What does a cost study cost, Steve? What does that typipy cost on different assets?
On a residential, it's pretty simple. Anything under $500,000 is $1,500. If it's on a residential under $500,000. When you get into the $4 or $5 million, $2 million, those are all based on each individual, but they're going to run from, I hate to throw a number out here because I need to look at the property first, what type it is and so forth, but they're going to be in the thousands, not tens of thousands, but it depends. If it's a $5 or $10 million property, it might be $12,000. And that's just a kind of a number out of the air. I don't have anything in front of me to quote that. So I hate to throw the numbers out there and people have expectations that aren't realistic. That's why we do the estimate. We do the
That's
estimate.
what you charge, right? And you provide that in the estimate. These are generally so under $500,000, flat $1,500
Yes.
cost. And this is, I think this is important to. I mean, you are who I personally use for my studies, as you know, and have for years. But I've heard of many cost segregation companies out there that will charge people, $3,000 to $5,000 for just a single family house. Now that is a tax write-off, the study itself, but still that seems a little bit overkill. So I think that's much more reasonable.
It would make sense that they're at $500,000 and under to pay that kind of money for a study. I mean, I would never do that. It doesn't make any sense to do that. I mean, that's why we try to price these as reasonable as we can, so you can do the smaller residential. And if someone's got a house that even 60 or 70,000, there are a few of those still out there, not very many, but if there are, it may or may not make sense. Again, that's why we do the estimate, to take a look at what kind of benefit are we going to get? How can you use it? And take a look, what's my cost and what's my benefit? Does it make sense? And then you and your CPA can make that decision based on your personal plans, what you plan to do, hold it or sell it or whatever you want to do with it.
So if you
another thing to discuss, you're talking about, I just want to get into it for a minute. If you've got that window between July of 2017 and December 31st of 2022, so we're in the 80% now because we're in 2023, but it's based on the date in service. So if you bought it in 2018 and haven't done a cost seg study, you can still do that. It's based on when you placed it in service, not when we did the study. So people that have properties they've owned for a few years, they should take advantage of the 100% because that doesn't go away for them. It's still there because they bought between that window of July of 2017 and December 31st of 2022. They still get the 100% bonus.
Can we talk about that a little bit more in detail?
Sure.
Can you run through an example though? Because so basically what you're saying is that if they bought a property, and the reason it's 2017 is because this was in part of the 2017 tax act that was put into play. But okay, so someone bought a property in later part of 2017 or 2018 or 2019, whatever the case is, and they've just been taking normal depreciation on it. They haven't taken accelerated depreciation. Maybe, this is the first year that they're really wanting to be aggressive and try to qualify for RE Pro and offset some of their active income because they previously didn't qualify. I mean, what does that look like? Does that mean, so I bought a property in 2019, does that mean I have to go back and amend 2019 taxes? Am I just doing a study this year? Yeah, like how does that work? Can you clarify more?
Without jumping in the weeds of it being the accountant, basically there's a form called 3115, which is change in accounting methods. You don't have to amend your return because you're going to take it this year or 2022 or 2023, but you're going to get the 100% benefit because it went in service prior to 2023 and after July of 2017. So you're not amending prior returns. You're just going to take the benefit on this return. And it's called a change in accounting methods, which the CPA should be familiar with. It's a form 3115. We've done it on some of your stuff, Zach, that you purchased before we did if you buy it now in 2023 or in 2022, and it's not on the depreciation schedule already, then there's nothing to change. But if you've had a property for 5 or 6 years and you've got an active depreciation schedule, we're going to change that depreciation schedule. Your CPA files a 3115 with your taxes to change in accounting methods for that particular property. Make sense?
Yeah.
So and it's still an option. Yeah.
Yes.
So even though your 5-year schedule is essentially done on those ones that you bought 5 years ago, you can still bring it forward.
Yeah, because those, remember, are on a 27.5 or 39-year schedule. So we're going to bring, even without bonus, if you bought it 5 years ago, that 5 years is going to catch up to 100% immediately without bonus depreciation. So if you bought something in 2016, for example, or early 2017, what is that, 6 years? All your 5-year depreciation is going to be bonused anyway because we're going to catch all of that up from 2016 to now.
Interesting. And so just in general, a couple of years from now, assuming it goes back to zero, does your 5-year stuff just depreciate 20% every year and your 15s roughly 6% every year? And that's kind of how it moves forward as opposed to the bonus depreciation.
Yeah, you'll just reclassify the asset, and you'll have. Let's just divide it now. Let's say it's 25%. Let's use 12.5% for the 15 and 12.5% for the 5. You're going to shorten that to 5-year and 15-year life, which gives you more depreciation annually in that case. Now, hopefully, they renew this and go back and keep it active, but we'll see what happens. It's up to Congress to do that. It depends on who's there.
Has there been any discussion about it? I know that it's phasing out, but I haven't heard any rumblings about this being something they're looking to renew.
You get opinions, but no, I wouldn't. Just opinions from everybody that thinks it may, just like opinions about interest rates or anything else. One advantage is also of an older property, if you think about it. If you bought a property in 2018 with all this crazy inflation we've had on real estate, for example, your increase in rents, the cash flow on those properties are probably pretty good today with what you purchased for, what you bought it for, plus the interest rate you're probably paying on it as well. So doing a cost seg on that just offset this gain you're going to have on your cash flow, which should be substantial, I would think, based on those factors.
So that falls into the classification of, if you when does it make sense? And if you have positive cash flow you're paying taxes on, maybe this is one way to combat that. But generally speaking, I believe on new construction, you do get a more attractive cost segregation study, right? You get more depreciated. Is that? I feel like that's
not necessarily. That just depends on the type of building and the structure, because they're all built, kind of the same way. If you go back to some built in the 20s, maybe it's different, but they're probably built pretty close to the same way. So I would think new construction versus existing is probably going to be in the same category, close to it. If you take a look at yours last year, Zach, those were not new construction, and the numbers came back really nice on those. And just 40% is probably. No, I want anybody to count on 40%. If we can get there, we will. But I'd say probably just a run-of-the-mill 25 to 35 is probably maybe an average of 30 is a good number to try to count on. And because I don't want somebody to think if they're getting 40, we come back at 27%, which is still good. But I don't want to set unrealistic expectations for folks thinking.
Well, run us through a numeric example. Maybe let's do this. I was going to pull up a report. I just found one of the recent reports from this last year, but then I realized it was 74 pages long. And I thought that maybe that just be, obviously I'm not the one reading, this is what the engineer produced, that all I'm paying attention to is what is the depreciable amount? And then here you go, CPA.
Scroll to the last page.
So that would probably be just people's eyes would glaze over if we looked at that. But let's use an example. Let's go through a real world example from our inventory sheet. Adam, let's choose one. Let's choose a new construction in Florida. I do think new construction you get a little bit better of a. There's just it's brand new construction based on, as you mentioned, the how it's built, but you get the full depreciable value there. Let's choose a property on our inventory list, Adam, and go through what we would expect numbers, just so someone can have something tangible to conceptualize. Would this actually make sense for me? And then we'll even go through and say, okay, how much of the actual, let's say, assume they're taking the active depreciation on it as a real estate pro. What are they what does that mean for their tax liability?
Okay.
All right. So here's one we have. It's a new build in Lehigh. It is 320,000. Rent's $2,650. So let's see. So now we go down to
Those are some nice interior photos. I think I want to buy one of those, Adam.
All right. So what all do you need here, Steve?
Well, I'm going to look at the total cost, what it sells for on so if they purchase it for $321,900, we're going to use that. We're going to take 15% for land. Typically,
but let me ask real quick: if we know that land is not 15%, if 15% is an assumption, if you don't, but if land is less than that, then you do want to take land. You do want to take less than that, right?
Yeah, we just want to justify it. I was about to say, I'll usually go to the CAD and see what the CAD shows. If it's new construction, they don't have a ratio between land and value. But if they do, I take a look at their ratio, because in this case, they may have it on the if it's a couple years old, maybe they've got it on the rolls that.
This lot is $15,000. So
that's what we'd use. And if they paid $15,000, we have something to document. We'd use $15,000 in that.
All right, so we'll call it. We'll just do
say 300.
Yeah.
For the improvement.
Well, let's do it exactly as we can. So let's say 322 is a purchase price,
Okay.
right? And because we want to be, as specific, a little bit of variance can make a big difference in the grand scheme of things. So 322 minus 15,000,
Mm-hmm.
and that's 307.
307, yeah.
Okay, so that's the improvement value. And so what would you expect your study to come in as an estimate on this?
Estimate probably 70,000. So it's 25% of that would be 75,000. So I'd use 70 to be conservative, and I'm hoping we come back at closer to 90 when we do the final study. But let's use even 70,000 of accelerated depreciation, and you're going to take 80% of that. So that's 56,000 you're going to get this year. And if you take 70 from 300, you've got 230 left. So you're getting 230 about 27.5. You're still getting 8,300, roughly $8,400 a year in your normal 27.5 year depreciation going forward.
Yeah, that's important for people to realize. Is just like how powerful normal depreciation is. Like and just in that scenario, like if you just took 322 and divided it by 27.5. Well, I guess I did that incorrectly because I needed to do 307.
307.
Yeah, so you're lowering your yearly depreciation by about $3,000 to save $56,000 this year.
From 11 to about 84. Yeah, you normally get about 11,000. Now you're getting 8,400.
But just
a big bonus.
So $11,000 depreciation per year. That's huge, right?
Mm-hmm.
That's pretty dramatic. Like depreciation is a big deal here. And for someone who hasn't calculated that out, like the first time I saw like, oh, this is a loss I'm taking every single year. But okay, so in this case, $70,000, you take 80% of that, you said, which was 56,000. I'm trusting your math here, Steve. So $56,000 of a lost year one. That means if you bought this one property, you still get the rest in the normal depreciation schedule. But you could take if you bought this property this year and rented it out, you could take $56,000 in accelerated losses against your active income. Let's assume you're in the 37% tax bracket. Let's assume you live in a state that doesn't have any state income tax. If you do have state income tax, then you factor that in. But $56,000, let's assume you're at 37% tax bracket. That's an actual tax savings that you would otherwise pay of over $20,000. Am I doing my math right here?
Roughly. Mm-hmm.
So that means that you can either, like, by doing accelerated depreciation and a cost-like study, by buying this property, you have an actual tangible year one tax savings of over $20,000 that could be an additional down payment on another house, which it should be. And now you're actually, instead of giving it to Uncle Sam, you're actually earning a return on that investment and buying another investment that then has another taxable benefit to it, right? I mean, this is how people build wealth, and this compounds really quickly is by paying less taxes, investing that money, and building more taxable losses here, or acquiring more taxable losses that compounds time and time again. But Adam, what was the down payment on this property? I just want to put this in perspective.
It was right around 80.
Okay, so you reduce it. That's if you're putting 25%.
We have everything at 25% now. So
let's just assume 322 at 0.2, 20%. That's $64,000. You can reduce, like, you basically, if you ran an accelerated depreciation, if you bought this house with $65K out of pocket using 20% down, you almost get 30% of that back immediately, like year one, if you did accelerated depreciation. Mm-hmm. Just from doing that, right? But this is big stuff to think about, and I mean, for stuff we're personally doing.
Yeah, it comes down to each individual situation. I mean, that's why we like to get the CPA involved, so they can take a look at their tax planning and what their income looks like. If they're under the 150, where they could take 25 towards their ordinary income as well, or if they own multiple properties and they can qualify as a real estate professional, that they can use it against their W-2 income, which is huge.
Just clarify for me. I know you mentioned this. I probably missed it though. So if someone bought a house last year in 2022 or 2021, when bonus depreciation was still at 100%, this year it's at 80. If they do the study this year, are they taking it at 80%, or is it?
If they bought it in 2022, they're taking it at 100% because it's the date it goes into service. And if they haven't filed their 22 taxes and they're on extension, like I am, like I always am, I do it every year on extension. You have until October 15th. As long as the study's done prior to October 15th, you're able to take it for 2022.
Is there a limit to how far back you can go? I mean, I know in the terms of the bonus, it's 2017, but is there a limit to when you can actually bring your study in? I mean, if you've had something for 10, 11 years, like.
Yeah, there's sort of a measure. If you've had it 15 plus years, it may or may not make sense because you've already taken, basically over half your depreciation on a 27-month year, and you're not quite there on a 39-year. But so it just depends. That's where the estimate really comes into play. Could we take into account what you've taken from your depreciation schedule, see what's remaining, and how much can we bring forward? And then does that make sense based on the cost of the study? So by and large, if you've had it 15 years plus, it may or may not make sense to do it.
And so in my mind, it's kind of like, why would you not get an estimate at least to know what your options are, right?
Yeah,
I mean, that's
where it starts, yes.
And then you can work with your CPA to see what like the impact would be. But yeah, if you own property and you have taxable income on those properties, maybe this might be something to consider doing. And if I understand it correctly, on with a lot of like the commercial assets or these larger assets, like there is a specific study you're actually walking the property for each one of those. But sometimes on like the sub $500,000 single family, I believe, Steve, it's just where you kind of take some data gathered from the sale. Like you're not actually walking the property. Is that accurate? Like, can you walk me through that?
We do that through an empirical modeling program. We take all the thousands of cost segregations that have been done over the years. We model that property against that, and it's defendable before the IRS to be able to defend that. That's the basis we use to come up with the accelerated components of the property.
Have you ever had to defend one of these to the IRS?
I haven't, in my time in the business, I haven't had one yet. And a lot of people think that this is some sort of a gimmick that causes the IRS. It's a red flag where they flag your return and they want to audit you. It's as long as you follow the IRS guidelines, it's no different than any other tax strategy that you use, because it's allowed by the IRS to use this on your properties that you own. So I haven't had one, but the engineers that I work with, they've had some and never had any issues. If you do it right, there's not any issues. If you try to take a piece of property and say it's 60% of it's coming forward this year, I think you're in for some trouble. Because as long as you're doing it proper and doing it right, that's why it's important that you do an engineered study and not just try to do that yourself. And I guess people could, and I've heard of people doing that, where they just go take and divide the property up the way they want to divide it up. And I think you're asking for trouble if you do that.
So when you're talking about, not doing it yourself, how do you know if you have somebody who's a legitimate person? I mean, obviously you've been doing this, but, let's say I got a cost seg study done a year, 2 years ago, whenever it was. And now I start to wonder, was it done? Maybe they came back at 50%. And now I start to wonder, was that wrong? Something wrong there. How do you vet out cost seg people?
References is what I do. I furnish all the references anyone wants to have to talk to people that I've done studies for. And I think, and if someone honestly came back at 50%, that would be suspect to me. I'd want to actually see some of their studies and talk to some of their clients and about what they've done over the past, how long they've been in business, things of that nature.
Steve, anything else we need to know about cost segregation? We know that the legislation is changing. This is something that could be applicable to anyone, regardless if you're a real estate professional or not. Just knowing like what it is and how to use it, and seeing if it factors into your investment strategy and plan. And hopefully, at this point, if anyone's been following us by now for even a short period of time, they understand that we're very passionate about educating people on the tax benefits, right, of real estate, because that is one of the biggest benefits of investing in real estate that no other asset class has.
That's why I invest in real estate. It's one of the best investments out there for the tax purposes and the cash flow, the appreciation, all the things that we know. The real estate's, even in this market, is still, I think, one of the best investments to be involved in. The main thing probably for your list of clients that have purchased in the past, anyone that has bought since 2000, anyway, in the last 10 years, they really should explore this, because there's bonus depreciation. There's also the person that's owned it for 10, 12 years, that they're going to catch up most of their depreciation even without bonus. So they should take a look at their portfolio and get an estimate on what you have and see if it makes sense for you.
Yeah, I mean, if you look at this and just it's extremely clear to me, and I know that when I first kind of learned about this years ago, it was a game changer, it was an eye opener for me of just seeing how the wealthy build wealth in real estate, and then compound that over year after year. And it's really a combination of taking full advantage of the tax benefits and applying these things. This, like doing a cost segregation study in combination with 1031, just perpetually, is a way to pretty much reinvest your capital. Even if you do sell that property and have to pay taxes at some point in time in the future, you would have had all this time of investing money in earning and acquiring more assets and acquiring more tax benefits and earning income on it and reinvesting those and compounding that. You would have had all that time versus just paying money to Uncle Sam that you never see back. Right.
Yeah, time value of money makes sense, and that's what cost segregation does for you. You're able to take that cash today that you normally send out to Washington and or wherever you send it to, and you would be able to use the money today, like you mentioned, 20,000 or so that you could use towards a down payment on another property.
And it's not like I'm anti-government and I don't want to be paying taxes here, right? Like I feel that the taxes are necessary and important, and they have their place. But understand that the IRS people, they put these things in place because they want to incentivize economic development, right? Like as real estate investors, we are providing a necessity for people, housing and business opportunities, or what you're, depending on the asset class that you're investing in. Like we are adding economic value and adding value to society in general, and we're incentivized to do that through the IRS tax code. And so that's the way you really should look at this. This is your right and a benefit to you investing in an asset class that betters our society.
Yeah.
And so I think that's just important to think of. This isn't about like, oh, we're a bunch of, snobby real estate investors to see how we can not pay taxes and scapegoat the rules. This is working within the rules and just being an educated investor, but also creating businesses and wealth through that. So I just wanted to end with that.
Yeah, It makes sense.
And someday we'll have a rent-to-retirement event where anybody who hasn't paid taxes because of real estate can get together and just chuckle together and tell tax stories of how
conspire against the government.
Makes sense.
All right. Well, Steve, thank you so much for joining us today. Really appreciate it. If you want to contact Steve, head over to Rent to Retirement, and you will see the Meet the Team page. Steve is on there. As Zach said, he uses him for his stuff. So, you can get a hold of Steve right through the rentretirement.com website. Just go to the Meet the Team page. If you have any interest in knowing what markets to invest in 2023 and would like a copy of Zach's report, email over to podcast@rentretirement.com and ask for the top 20 markets to invest in 2023, and we will get that sent over to you. Please leave us a review on whatever podcast platform you use so other people can see that our show is something that is helping you in your real estate journey. Appreciate the time you're spending educating yourself on your real estate journey, and we'll talk to you on the next episode.
Thanks for watching the Rent to Retirement YouTube channel. Check out some of our other videos, like this one, or this one here.